right, everybody. Well, we are going to go ahead and get started. Thank you guys all for being here. My name is Hope Anderson. I'm the COO and head of client success here at Digifox. And today we've got with me in the Zoom studio, I suppose, here, Nicholas Merten, founder and CEO of Digifox, and also founder and CEO of the largest crypto, one of the largest crypto YouTube channels in the world, Data Dash. And he's going to be talking a little bit about dollar cost averaging here. After the webinar, we are going to be doing a live Q&A, so feel free to ask us any questions you want. I would ask that you please put your questions in the Q&A box at the bottom of your screen. It should be a little box at the bottom of your Zoom screen window that says Q&A. Put your questions in there. They're likely to get lost if you put them in the chat. Otherwise, feel free to just banter back and forth with each other in the chat. But the questions for the Q&A need to be put in the Q&A box, please and thank you. So without further ado, I'll hand it on over to Nick and we'll get some talking about dollar cost averaging.
Awesome. Thank you, Hope. I appreciate it. It's awesome to be here and have all of you guys here for this really important topic. It's something that's really close to my heart is making sure that we don't lose out on this opportunity that we're witnessing right now. I don't mean to try to sell it to anyone, but I think all of us realize that cryptocurrencies are really a once in a lifetime opportunity. And one of the biggest things that I see that's a mistake that people make is that they approach cryptocurrency markets for the first time and they go about investing trying to overly participate in the market. The problem is that this can get in the way of you actually capitalizing or realizing the returns that can be made within cryptocurrency markets. So we want to be able to find a sweet spot in this case. We want to be able to find a stress-free situation where you're able to make great returns in the long run, and also talk about the macro environment in this case of why what we're talking about today is so important. Real quick, Hope, if you wouldn't mind, I need to share my screen here real quick. So we'll get that going in just a sec, guys. All right, let's see here. Should be good now. Okay, awesome. There we go. All righty, let's go ahead and jump straight into it. I'll see my screen here good?
Yep.
Awesome. All righty. So what we're going to be talking about today is dollar cost averaging and why, in my opinion, it's the ultimate approach to cryptocurrency investing, and why our newest feature, Get Paid in Crypto, encompasses dollar cost averaging as a passive way to start garnering exposure to crypto. So before we start diving into talking about crypto in any capacity, we're going to talk about the macro environment, what may seem quite boring, but is actually quite exhilarating and at the same time a bit scary. So when we take a look at the global economy where we are right now, post-COVID in this case, we've been through basically about a year and a half worth of incredibly experimental monetary policy. We've got central banks and federal governments across the globe that have initiated massive amounts of monetary printing, lowering of interest rates, which lowers the cost of new money. And outside of that as well, stimulus programs, giving money out to individuals in the form of stimulus checks or other forms of government handouts or supplemental income. And all these things have finally started to reflect in the form of inflation. We've started to see what was, again, for many years, a supposed struggle of central banks. They wanted to actually increase the inflation rate, right? In this case, were they able to meet towards their claim, at least according to their data. And now we're seeing a true reflection here in this case of inflation hitting the economy finally in 2021 and predictably going into 2022 from the original range of around somewhere in the 1% to 2% range, all the way up here towards 5%. This is basically meaning that, according to the Federal Reserve, the cost of goods and services, generally speaking, is going up about 5%. There's another metric here that is utilized by the Federal Reserve Bank of Dallas. It's something called the PCE inflation rate, reading again in that upper single digit territory, starting to press towards 5%. Now, again, at the end of the day, there's going to be a lot of debate overall about which numbers are correct. If the numbers provided by the Federal Reserve or other federal officials or central banking thought leaders in this case is either too high or too low. Generally speaking, I think the wisdom sentiment is what you see every single day when you go to store, when you're looking at property values, if you're looking to buy a new home or rent in this case, or planning for college. The cost is generally at the numbers provided by these different types of institutions, if not much higher. I would be, safe to say in this case that I think we're generally seeing more towards around 7 to 10% inflation, especially during these unique times that we're in, and usually seeing more moderate 3 to 5%. The numbers are around 1 to 2%. So generally estimating the numbers are going to be worse off than what we're seeing. So that already puts us in an even more contextual situation where we have to find out, okay, we've got this problem in this case, which is the depreciation of money. And therefore, our net worth or our wealth in this case is going to be affected by that depreciation, albeit in this case, our purchasing power is declining, right? The ability of $1 in our bank account to go out and buy goods and services, right? If the cost of goods are going up, we need to be able to take our net worth and our wealth and hedge it in some kind of manner from rather than just letting it sit in a bank account, right? So we've got a serious problem here, right? We had what might be the proper macro response to get the economy back going, but it comes at a cost in this case to savers and those who have really worked long and hard to be able to build up their wealth. So we have to go about finding an asset in this case, or an asset class, broadly speaking, that would be able to position ourselves in a position where we'd be able to hedge against this inflation. What kind of assets have the kind of growth or percentage returns that will get us in a position where we don't have to worry about the Fed's inflation? I'll dive assets. And obviously one of them that you guys can probably guess we were going to talk about is Bitcoin. Now, what we're going to be talking about today is not just Bitcoin as a whole, but talking about the broader crypto space and the methodology behind dollar cost averaging. So when we're talking about, generally investing in the markets, there's all kinds of markets you can get returns in. There are cryptocurrencies, which we'll talk about, but also there are equity markets, generally known as the stock market. There are commodities like gold and silver. There's all kinds of different investment vehicles that you can invest in. You can invest in real estate, bonds, whatever you may think of, right? But what I want to make the case for here today is that we need to find something that has not only consistent, solid returns that outpace other markets. We want to find the best performing asset and track record to continue growing. But outside of that as well, an asset that no matter how volatile the market is something we can average into and has further. So we'll talk about some of the key things that make crypto that optimal asset class. I'm not going to leave you guys hanging. In this case, crypto is the answer in my personal opinion. So I'll go ahead and dive into it. Let's go ahead and take a look at a really simple visualization. Now, don't let this chart overwhelm you. What we're taking a look at here is Bitcoin's price chart over its entire life cycle. And what each of these candles represent is they represent a year's worth of price action for Bitcoin. So we're going all the way back here to January of 2011, all right, to where we are here today in 2021, right? We're coming to the close of the year here in this case. It's been a big year for crypto, right? But it's one of many great years for Bitcoin's annualized performance. So we can see here, if you guys take a look at the screen, you might be able to read it well, but in the top part here, we've got the percentage return as I scroll over each. Now, what you'll see is that, generally speaking, there are only 3 years that Bitcoin has had an annualized negative return. All right, we can see back here in the first year when it started out, it had gone through an extremely small pullback in the grand scheme of things. We can see that there was a pullback here, 56% in January 2014, and a pullback in 2018 of over 73%. I can sounds like something that might throw you back from wanting to invest in crypto. But if you think about it on a long-term perspective, if you're investing for the future, your time preference likely isn't a week, a month, even a year. It's probably multiple years. And what you can do is average into the market over time And if you weight the average annualized return in this case, even considering these brutal sell-offs in crypto markets, right? You can see here that the annualized returns not only outpace the sell-off after some time, but they continue to grow towards new all-time highs and make exponentially higher returns in this case, right? We generally get in bull markets these breakout years, like back here in 2013, where we saw 5,428% return. Here in 2017, a 1,336% annualized return. And we've seen so far over 2020, during a crazy year of this period of inflation, where we were able to see a 300% return of Bitcoin, and so far a 117% return, 116.95% return so far this year in 2021. This has beaten out every single asset class as a whole. And as you can see here again, even if you had bought, in this case, you started buying Bitcoin at the peak here of the last cycle, you'd still be up on your money far beyond any other asset class out there during the same period of time. Don't believe me? Let's go ahead and dive into some visualizations. Don't take my word for it, right? Let's go ahead and take a look at Ethereum here, right? Another cryptocurrency asset, right? Same exact equation here. Major returns, right? Major leaps and bounds, passing the previous all-time highs, even after these brutal corrections, an 82% pullback back here in 2018. Soon after, in a couple of years, recovered past it and started making exponential returns. All right. But again, let's go ahead and compare the other assets here. Let's go ahead and talk about other asset classes, right? We've got the S&P 500. S&P 500 has been killing it in this case. It's been doing great. But over the last 3 years, it's had an annualized return of 28%, 16%, and 21%. Not as good as Bitcoin. In fact, nowhere near the kind of returns that we can get with Bitcoin. Albeit the corrections are a little bit less severe in this case. Still, statistically speaking, you're going to be making a much higher percentage return as you start to expand your time frame, right? As you go from an average 1 year investment to expanding towards 3 years, 5 years, whatever your time preference, the more and more beneficial crypto is as an asset class versus investing in the S&P. Gold here, right? Gold's had a pretty good set of years here since back in 2016 as it started to recover from its bear market, had a pretty severe correction in 2013 and continued downward, right? We've seen gold nearly double here since 2016. Generally good annualized returns like equity markets. But the problem here is that, again, you're not seeing substantial returns like crypto. You're seeing returns like, for example, 8% here in 2016, 13% in 2017, in 2018, a neutral year, generally speaking, an 18% return, 25% return, and so far a negative year in this case of about 6%. And even if you take gold during its bull markets back a couple of years ago, good double-digit returns on a lot of annualized years, but still nowhere near the kind of triple-digit returns that you're going to get in crypto markets. And that was a previous bull market. You're likely not going to expect the same kind of returns here that you got in the previous one, right? At least some kind of decay in return. So we expect that with crypto. But again, we're going to showcase here how there's still so much more room to grow in this case on an annualized basis for crypto, even with decaying returns. That's expected with any market. Now, if we take a look at the last decade and start to compare visual basis, it's just become very clear here that Bitcoin and cryptocurrencies as a whole have outpaced the other asset classes. An individual named Charlie Baleo, in this case, put out a really interesting tweet here, a really interesting chart. He compiled return of various asset classes and indices within various different markets. So we can see here, as we take a look at it, we've got a variety of different assets. I'll go ahead and zoom in so you guys can see. This might be a little bit blurry. We have the different types of assets out on the market, the respected trading symbols, the annualized year in this case, 2011 through 2021 to year to date. This is as of March 13th of 2021. We can see each year the percentage return green or negative, indicated by green or red, right? Positive on the upside in green, downward in red with a negative percentage, right? We can see the different types of returns over time. And what we can see here as well is the cumulative return during this time period, which is the overall return during this time window. and the annualized return. Now, I'm not going to focus so much on the cumulative return. It's obvious here in this case, Bitcoin would have the largest cumulative return, something way sizable beyond all these assets, because it was a new asset and launched back in 2011. That's not what I'm here to make the case for. What I want to focus on is the much more moderate and realistic metric that we need to focus on, which is the annualized return, right? Even if we start to discount some of these really great glory days, the early days of Bitcoin, where it was very easy to go from investing a couple $100 into being, in this case, we still have a great annualized return. And we can see that over the past couple of years, the annualized return back in 2019, 2020, 2021, even after having these bear markets, these pullbacks, still are going to leave you in a position where you're outpacing the NASDAQ, you're outpacing small caps, the S&P 500, any commodities, any kind of asset class, right? And this is a great visualized way to see it here. And you can just see on this annualized return basis that crypto still stands out way beyond other asset classes. And what's the case? It has to do with something we call a reference as markets of scale, right? If I, for example, was taking a stock in this case, right? A company that's doing something innovative. And then you've got a large company in this case. So a small company doing something innovative and a large company doing something innovative, right? The small company is valued at $100 million. Then you get the large company that's valued at $10 billion, right? I want to leave you guys with a quick thought experiment. Again, putting aside the fundamental sort, which of those companies do you think has the likelihood of doubling in valuation? So you're going from $100 million valuation to $200 million, or the large company going from $10 billion to $20 billion, right? Now, it's not always the case, but in most cases, you're more likely, in this case, to have the smaller company doubling in valuation. It's much easier to go from $100 million to $10 billion to $20 billion. Requires a much larger degree of buyers coming into the market to drive valuations higher. It's simple inflow and outflow principles of markets, right? Well, with crypto being a market in this case, it's just a little bit over $2 trillion in valuation comparative to equity markets, which can be valued as high as $120 trillion. Or gold, which is a $12 trillion market. You can start to see here, if you think about that same thought experiment on a macro level against other asset classes, which one is more likely to double? So let's go ahead and visualize these markets of scale. Let's go ahead and get an idea as to where crypto stands. Well, this was an article that came out of Blockworks back a couple months ago at the start of the year in January. And even though the visualization here is a little bit off, crypto is a little bit bigger than this little dot that you see here within the chart, we can start to see when we compare markets like real estate, debt securities, so all forms of debt within the system, equities or the stock market, global GDP, global monetary supply in this case, right? The money supply, gold, the FANG stocks, all the major technology companies. We can start to see that crypto is relatively small here, right? It's a small part, a cog of the overall equation of the financial system. It is not that big. And if you think about any of these markets doubling in valuation, it's likely that crypto in this case is probably going to double. Just like how the FANG stocks might very well double faster than the broader equity market or global real estate, right? Now, again, market scale doesn't always, in this case, that equities are going to more likely double than global real estate, right? When you start to get towards being larger and larger markets of scale becomes a little bit less relevant. But if you're taking an exacerbated large market like real estate, you take something like crypto is obviously going to outpace real estate over the next decade, right? So let's take a look here as well at another thing that's important, right? When we're talking about investing in things, no matter if your time preference is a year or a couple years or a decade or possibly up into the point of retirement, that could be for many people multiple decades. Well, when you're taking a look at assets in this case, you want to look in this case for volatility. Now, I know that volatility scares a lot of people, but volatility not only means sometimes more dramatic corrections, but much more dramatic upside and faster momentum in receiving returns in this case from your investment. What's really interesting is that Bitcoin, comparative to the major tech stocks here, you got Google, Amazon, Apple, Microsoft, took them 21, 24, 42, 44 years to reach over the $1 trillion market cap, right? We saw that for Bitcoin in under 12 years, practically half of what it took Google and Amazon, respectively. And in this case, just a little bit over in this case, a little bit under actually, 1/4 of the time from Apple and Microsoft. Absolutely incredible stuff in the sense of the speed that this asset is growing at. Now, I know we've been talking very macro level here, and there's one last chart that I want to show you guys, a really interesting website you can use. This is companiesmarketcap.com. And you can see here it compares Bitcoin as an asset against other major global companies, as well as commodities and gold. So this is a cool website where you can track how Bitcoin has grown over time, right? But we've really taken a good macro look here. And I think we can come to the conclusion, even though some might disagree, some might agree, that overall cryptocurrencies are one of the best, if not the best assets to look at allocating yourself to some degree in your portfolio. It doesn't have to be your only asset, but one of the assets in this case that you allocate yourself to plan for your future, to hedge against the macro environment inflation. But a lot of people get stuck on the third topic here that we're going to be discussing, which is how do you get engaged with crypto, right? Because crypto is incredibly volatile. It does have these major downswings, albeit it has major upswings, and every single time sets in higher lows and higher highs, which generally means it's going on a long-term uptrend to the upside, right? What's the best way to approach crypto markets? Where do you get started? Well, what if I told you one of the simplest solutions not only could give you a stress-free ticket into crypto markets, one that's going to be a lot less stressful than other approaches like trading. That as well is going to be an approach that could actually give you a strategy that beats out the majority of the market and puts you on top with someone who can perfectly time the market. It might sound a little too good to be true, but we're actually going to dive into some really interesting metrics here. Charles Schwab, a major financial company, put out a really interesting article back earlier this summer. And they really focused on this topic in relation to portfolio management, which is, does market timing work? To always time the market, whether you're trading or investing, people want to get something at a discount, in this case, at a favorable price, so they can sell it at a later date. That is every single asset market. It doesn't matter if you're investing in the stock market, crypto. The name of the game is to buy low and sell high, right? We all generally know this, but the key thing here that a lot of people, always get so caught up on is they want to get so active into trading and trying to find the perfect time to buy the bottom of the market, right? And what you may find to your surprise in this case is that timing the market really doesn't give you much added benefit, right? And we're going to see how something much more simple actually gives you practically the exact same results. So Charles Schwab is an equity brokerage company at its core. It has a lot of other services, but they focused on 5 investing stocks an investor could take on investing in the stock market over the past 20 years, ending in 2020. So let's go ahead and take a look at these different personalities. They first start off with the most optimal scenario. And this is what everyone desires to be. They desire to be Peter Perfect. I love the names they came up with because they match with the situation that they're in and how they approach markets. Peter Perfect is a perfect market timer. He has incredible skill or luck in this case and was able to place $1,000 investment on an annualized basis at the perfect lowest point in the market on that year, right? So no matter what time of the year in this case, he gets the lowest point in the market. Every single year, he's averaging into the market $2,000, right? So and back all the way 20 years ago, it started 2001, right? 2002, 2003, he's getting it at the lowest point possible. And he's invested $2,000 in this case, right? So for example, he was investing in September 21st of 2001, right? And also at the beginning of 2002, Peter received another $2,000. So he's doing this every single year. He's averaging in $2,000 new dollars of cash at the lowest possible point, right? He's got that market insight. He's got that eye for the markets. He's got a knack for investing, right? So that's what everyone wants to be. But as we'll learn later on, and I think most of us already understand, being Peter Perfect is not easy. And the vast majority of investors, over 99.9%, will not time the market perfect. It is statistically an anomaly to be able to be Peter in this case, right? So let's not stress about being Peter. Let's go ahead and see some of our other personalities here. Ashley Action. Ashley Action takes a really simple approach. It's very consistent, very gun-ho. She's eager to get in the market. She has $2,000 at the beginning of the year. She just goes ahead and invests in the market on the first trading day of the year, right? So she just puts her $2,000 right into the S&P 500, no questions asked. She's investing in 500 different major companies throughout the global economy, predominantly in the US, right? Just like that, no question, no bars asked, right? So that's an interesting strategy, right? We'll take a look at the returns here in a little bit. Let's go ahead and understand the other personalities. We've got Matthew Monthly. Matthew Monthly has divided his $2,000 aliment in this case, or his cash for the year, into 12 equal portions, which he's investing at the beginning of each month. So at the turn of each month, right? January 1st, February 1st, March 1st of each and every year, he's investing $200, apologies, for 12 months. Right, so he's dividing, in this case, that 2,000 to 12 fragments, right, over each and every month. And he's slowly but steadily averaging into the market. He's not trying to buy it at the immediate first part of the month, put everything on the table, putting all his chips on the table, right? He's putting a little bit each month, right? So again, this is what we'll talk about later on as a form of dollar cost averaging. Rosie Rodden, in this case, has incredibly poor timing. And the unfortunate thing here might just be that she has bad luck. She's spending her $2,000 at the worst possible time. She's buying the tops of every single year in this case, not per se a overall bull market top, that might happen every couple of years, but she's buying at the worst time in the year in this case, averaging her $2,000 in. She's got to make a loss in this case, right? Well, we'll take a look at that in a little bit later. Last thing here is Larry Linger. And this is by far the worst position you could be in. This is where Larry Linger is just simply having his money in cash, his money in a savings account, or in things, in this case, like in the example, like treasury bills, okay? Treasury bills that give you some kind of yield. They're IOUs from the government. They're bonds in this case, right? So Larry Linger is staying away from the stock market. He's not investing in it. He sees it as too risky because of volatility, right? The common concern that hits everyone, right? Well, let's go ahead and take a look at the results. Is that we find two strategies work incredibly well outside of the predictable winner, which is, in this case, the perfect timing in this case, or as we talked about, Peter Perfect, right? And we know we can't be Peter Perfect, but what's interesting here is if we take a look at the results, we're not too far off from Peter Perfect. Sure, Peter Perfect in this case made the best return in this case. He made a return that's about $15,000 more than investing immediately or dollar cost averaging. But what we find here is we not only made much more of a return in this case, taking the risk of investing in the stock market, and whether it be investing immediately, dollar cost averaging, or bad timing, we still made exponentially higher returns than where we were within cash investments. And the really cool thing about dollar cost averaging, investing immediately, is that generally speaking, we did great, we made awesome returns, and we didn't have to stress about it. We were able to capture and materialize the great returns offered by the market, and we didn't have to time the market perfectly to make a great return, right? Now, in a market like the S&P 500, which in this case is established, has general annualized returns, right? Investing immediately in this case at the beginning of the year, right, might not be a bad idea, right? But for crypto, we find that dollar cost averaging is a really, really good means to invest in the market, to get into crypto, as you're basically buying in the low points, the mid points, and the high points of the cycle. And what you generally get is a really nice annualized, in this case, or smoothed out return over time that helps to mitigate volatility. Now, it's hard to get a visualization of this sometimes. And even though we had a little drawing here in this case, and I would kind of gauge you all to think about it this way, right? As Bitcoin's growing over time, we generally have this nice smooth line return where your capital is growing alongside Bitcoin's general trend upwards, right? But let's go ahead and actually utilize some really cool tools to visualize how powerful dollar cost averaging can be. This is a website. You guys are welcome to use it. It's called dcabtc.com. It stands for dollar cost averaging Bitcoin, right? So we can start to utilize this tool to track, in this case, how our performance would be dollar cost averaging into Bitcoin. Now, again, taking a step back again, what is dollar cost averaging? It's just like we saw in this case with Matthew. I think it was Matthew Monthly in this case, if I got the name right. Let's go ahead and see if I'm right on that. Yep, Matthew Monthly. I love the names they created, and it's very catchy. So we're like Matthew Monthly in this case. We've decided that there's a problem, inflation, right? The broader macro environment, and we need to protect our purchasing power. And we've decided that crypto is the market we're going to do it in. Well, let's go ahead and do what Matthew did in this case. Let's dollar cost average. That's what he effectively did. He invested on a fixed time interval. He didn't care about what the price was today or what his sentiment or emotions, what the news was saying about the markets. He just simply invested in the market when it made sense in this case, right? Basically on a fixed time interval every week, every month, every year, right? Depending on what time interval works for you. What we found in this case that works really good and is something that's reasonable for people is investing in a bi-weekly time frame. And we offer this through Digifox through our Get Paid in Crypto feature. Now let's go ahead and actually visualize why getting paid in crypto or a portion of your salary paid in crypto might actually be helpful. So we can take a look here at the dcabtc.com tool or dollar cost averaging Bitcoin tool. And let's say every 2 weeks, right? So we've got our repeat purchase here. Every 2 weeks, we're going to purchase $200 of Bitcoin with cash that we have, right? And we're going to accumulate in this case for a year. So we're going to keep this pattern of adding for a year, and we're going to have started it over a year ago, right? So just about a year ago in this case, October 2020 is when we started. And what do you know in this case, right? Let's go ahead first. I'm going to turn off other assets here. This green line here is your actual cost basis or the total invested. So after a year, we've invested $5,400, right? Now, if we just put that away in a bank account, that'd actually be great in this case, right? Having money set aside, there's nothing wrong with that, right? The problem is inflation, the depreciation of our purchasing power. If there wasn't this mass inflation, just putting your money in a bank account would actually be a pretty good deal and would probably be a good, healthy thing to do. But in an inflationary environment, we need to find assets that are going to outpace inflation. What do you know? Even with Bitcoin's crazy volatility, everyone panicking in this case about how Bitcoin's so volatile and so crazy. Bitcoin, not only from back here in October, started to outpace our initial cost basis or our total invested, but even during corrections like the one we saw back in May, still remain above your initial investment and lead us to where we are here today, where our initial investment of $5,400 has nearly doubled in this case to $10,680. Pretty incredible stuff, right? Now, here's the even cooler thing. We can not only compare it here in this tool towards our total invested, but let's say in this case, we wanted to compare how it would have done if we invested in the Dow Jones, which is very similar to the S&P 500. It's a stock index. It gives the 30 largest companies in the stock market and their performance. Well, we can see the Dow Jones over the past year has outpaced just investing in, to a savings account, right? Our original total investor cost basis by about, $400, $500, right? Not bad, right? Starting to help us hedge against inflation to some degree. Let's take a look at gold. Gold has actually underperformed just having money in a savings account. The supposed store of value that we should be able to turn to is not per se doing its job, at least not over the last year. Well, let's go ahead and expand our time frame. Let's be fair to the other asset classes and outside of that as well to Bitcoin, right? So let's go ahead. We will accumulate for 2 years. We're going to go ahead and expand our time frame 2 years ago. Oh, wait a minute now. This is crazy, right? Now, in this case, gold has started to actually, pretty much stay actually still intact with the dollar, right? Just being able to save your money. The Dow Jones has had about 20-30% return on top initial capital, right? Man, if we look at this orange line here, we've got Bitcoin. We've got Bitcoin dollar cost averaged over time. And what we start to see here is that our initial investment of $10,741 is now worth, nearly $47,000, a 4 capital. Now tell me about another market that's going to get these kind of returns. Now, to be fair here as well, this is coming out of a period of time where Bitcoin was at a relatively low price. Let's go ahead and take it with a grain of salt and step back even further. Let's say, for example, we've been accumulating for 3 years in this case, right, for Bitcoin, right? Now, this is still during when Bitcoin was at a low price, but you can start to see here when you start averaging in this case, in the market, whether you come later to the party or really early during a bear market, right? The general preference here is that the longer back we go, it's going to generally favor Bitcoin here, right? A more expansive asset, market to scale, right? Let's go ahead. Let's really take a step back here. 4 years in this case, right in the middle of, in this case, 2017, right? So this was going into the peak of the bull market back in 2017 and then into the bear market. Now, what we can see here, and we're going to go ahead and actually take a look at this in a logarithmic fashion. This is going to help us actually scan back here because Bitcoin just gets so parabolic that it starts to way outpace everything, right? What we can see here is that dollar cost averaging into Bitcoin, and this is an argument that a lot of people make against dollar cost averaging, but they don't actually do the research in this case into it, right? And they'll say, well, Nick, right, that's favorable time to dollar cost averaging, what we looked at 1 to 2 years where Bitcoin was at a lower price. What happens if you bought at the top in this case, right? You started averaging in towards the euphoria. Well, here's a great example of that. This is where a user in this case was dollar cost averaging, started 4 years ago, and they started to outpace the market. But then they really started to get hit with the bear market, right? When Bitcoin started to dip in price. And you can see here that there was even a period of time where the initial capital invested was 6,000, but the price of the valued portfolio was 2,742, right? That's in the worst case scenario, one of the worst case scenarios, starting to dollar cost average at the cycle top, right? It'd be like buying Bitcoin at the top in this case, right? It's one of the worst possible scenarios you could be in. The crazy thing is that within a mere matter of months, we were able, from back here in December 2018 up towards May, in a matter of 5 months, recover back with your normal base capital, right? Just the total invested, or the S&P 500 or gold. And look at that. You start coming back up here in this case, riding above the other assets, and then you start to expand higher. So what's the lesson here, right? As we expand further and further back here in our accumulation, we can see here that generally speaking, Bitcoin continues to outpace other asset classes. And it gets more and more expansive as your time frame expands, right? To where 7 years ago, $36,000 would now be nearly $2.2 million. By saying that if you invest in this case into crypto right now, and you follow this pattern for 7 years, your initial capital, which would be still $36,000 in this case, $36,600 is going to be equal to 2.2 million. No, I'm not saying that. But you still have the opportunity here, as crypto is only around a little over $2 trillion market cap in total value. It still has much more market to scale versus the S&P 500, the Dow Jones, the broader stock market, gold, which really can't escape the dollar in this case as much as Bitcoin can. And escape velocity to the upside, right? There's some other tools here. This is just for Bitcoin we've been taking a look at. We could also do it for Ethereum, right? Ethereum, there's another website, dca-cc.com. If you just look up dollar cost averaging Ethereum, you'll be able to find it online. And they have a very similar tool here. We can do Ethereum and a variety of other cryptocurrencies, right? Ethereum is another asset that we're supporting through Get Paid in Crypto, where you're able to deposit $200, right? And just like we would have here on a biweekly basis. This is over an annualized basis. So we can see here, if we scroll over to the side, the chart here for our initial investment by the end of a year, it'd be $5,400, $16,835 for Ethereum. We're talking in this case about a near 3x here in this case in valuation. An ROI of 211%. Major returns here. Something, again, you're just not going to get in the S&P 500 investing in stocks. So I've rambled on a good amount this long in this case. I want to give you guys a gold medal in this case, because this is the kind of knowledge in this case that unfortunately a lot of people don't have when it comes to crypto. and prevents them from making that leap of faith into this new and exciting asset class. And they miss one of the few lifetime opportunities that are out there. And that's why we're so big about get paid in crypto. There's so many things out there. There are exchanges and companies out there that will encourage you to overtrade, stress out, try to catch one opportunity to another, behind losing gains and opportunities in the market. Whereas in this case, one of the simplest strategies may be your best friend into getting into crypto markets. I'm a big fan of dollar cost averaging personally, and I genuinely believe in this case, it's one of the best ways for people to get involved, or at least started, get their foot wet in this case, in the market. Now, one thing I struggle with, in this case, with the actually action in this case, is just going all in this case, with the amount of capital you have right away. And we can see, generally speaking, that the returns are not that different in this example, right? In an early market like crypto. So getting your feet wet and not per se setting a cap on how much you can invest, just putting a little away each week, start to realize that it's actually not that scary and that you'll want to probably get more and more exposure to crypto, right, over time, just like you would with stocks or other investments. So anyways, guys, that's it in regards to the presentation here. I hope you guys weren't too bored with my my rambling and raving, and I'm really interested to dive into some questions here from you guys if you have any.
Awesome. Well, thank you so much, Nick. Really appreciate it. I know it's like also super late where you are, so thank you so much for
It's all good.
Really
crypto
late.
never sleeps. Crypto never sleeps in this case. As much as you can with dollar cost averaging, I never sleep when it comes to crypto. I'm a little more active in this case in the market.
You kind of have to be. I remember the day that I found out that the market closes. I was like my first job, and somebody told me like the market's closed, and I was like, the market can't close. The stock market. No, that's funny.
That's very funny.
Alrighty. So I had a couple questions that I had pre-written here, and then if anybody has any questions they want to ask in, I will jump over to those. Please put your questions in the Q&A box at the bottom of the screen, and I'll jump over to them. Oh, looks like we got one. Anonymous attendee says, how do you know that Bitcoin and Ethereum will continue to grow at rates much greater than other assets? That's a good question.
So I think the biggest principle here is the market to scale aspect. Again, the size of the market in this case. Again, if you take equities in this case, so when you're talking about investing in the S&P 500, the Dow Jones, the NASDAQ, you're generally taking broad indexes of the entire equity market, which is $120 trillion, right, globally. For all those equities in this case, even if you're a good stock picker and you maybe invest in more high growth areas like the NASDAQ, which is technology, you're still getting annualized returns that are nowhere near even the decaying returns of crypto. And what I mean by decaying returns is that you're not getting those exponential returns we talked about earlier. There is no guarantee at the end of the day, guys, to be completely fair, that crypto is going to outpace equities. I'm not going to sit here and say, put everything in this case into one basket. I do agree with the diversified portfolio, but on a data science perspective, on an analytical perspective, there's no way in this case that equities, which are a $120 trillion market, have a higher likelihood or probability, according to history, to double versus crypto, which is just at a mere $2 to $2.5 trillion market cap and valuation. It's much easier for crypto to go to a $4 to $5 trillion market cap than for equities to go to a $120 trillion market cap to a $240 trillion market cap. That would put equities very close to rivaling with real estate, a global real estate value. So that's just not going to happen on an annualized basis.
Okay, cool. Carlos says, what are your thoughts on bots like 3 commas or the ones on KuCoin?
Yeah, I mean, look, there's a lot of bot strategies out there, and honestly, although there are a lot of scammy bots, and that's why I kind of generally tell people to stay away from it. There are some very valuable ones out there that will do automated trading strategies, things of that sort. There's one big thing though that trading bots in this case fall short on. If you're in the United States, I know a lot of our users are in the US, or for example, if you're in most Western countries, the problem that you're going to run into is that with a trading bot, if you're a law-abiding citizen, you're gonna have to pay taxes and keep record of all those transactions. And the problem with that is that any gains that you should make with a trading bot, most of them, unless they're buying something, and holding a position for more than a year, at that point, it's really not a trading bot. You're going to be paying short-term capital gains versus long-term capital gains. And in the US, that can mean in this case that you're paying effectively 30, if not more than that, 40% tax gains on any returns you make off of your original cost basis versus long-term capital gains, which would be more around 10 to 20%. So even if you have a trading bot that might, get good returns, the two things that hit my mind are, is it better than dollar cost averaging? Most of them are, surprisingly enough. That's the thing that a lot of them don't tell you. And outside of that as well, are the tax obligations going to make, even though I might be able to make more returns, if I consider tax obligations, it might make the sentiment of doing anything outside of dollar cost averaging less favorable. So I don't personally use trading bots. Again, I'm a big believer putting my money where my mouth is. In this case, I don't do any trading bots in this case. So again, I would say stay away from it generally, but there are some cool platforms where if you know how to back test strategies, you can definitely build them for sure.
Carlos says appreciate the insight. Anonymous attendee says, could governments use cryptocurrency to make welfare programs more effective or reliable?
That's a good question. There's been, I think with the introduction, and not so much the federal government, but the central banks in this case, like the Federal Reserve, would probably be, well, I actually would say in partnership with the Treasury and probably some new legislation related to social welfare programs. They could definitely, in this case, streamline the welfare process. I don't mean to be too opinionated or dive into politics, but one of the biggest issues with a lot of entitlement programs or welfare programs in the US, a lot of the big cost basis of it is generally all the bureaucracy of getting money from point A to point B. That's the goal, right? We want to get people money, in this case, who need it. That's at least the idea of the program. There's all this cost in the middle, all this bureaucracy. Whereas if the Fed, in this case, or federal officials through a central bank digital currency would be able to just deposit money into your bank account, that would be a much more effective means in this case. Like literally like what they did with the stimulus checks. It was exactly a test of this. And even though it wasn't in the form of a central bank digital currency, it just went straight to your bank. Not saying that it's a good thing, overall, like that, central banks or federal government has that ability to just go ahead and inject money into bank accounts or offer free money. But it's definitely a much more effective means than the existing system, which goes through a ton of layers in this case. And crypto could cut the cost down, increase, shorten the settlement time, and possibly have other added benefits in this case. But those are really the main ones. In the sense of like, doing it better than crypto, you're not going to get the returns in this case you get with crypto, generally speaking.
Awesome. Thank you. So you talk a lot about dollar cost averaging. This is kind of a question that I wrote down while you were talking. So if anyone has more questions, feel free to jump in, but I'm going to jump in now because we have no open ones at the moment. I feel like a lot of people, when they're looking into getting into dollar cost averaging or getting into crypto, it's like everything's really overwhelming. There's so many options, and they think to themselves like, oh, I don't have very much money. Like I can't really do thousands of dollars every month. I maybe could do like maybe a couple $100 or $100 or maybe even $50 every month. Can dollar cost averaging still work for me? That might be a question you might have.
That's a phenomenal question. And that's the thing that, to be honest, when, all the years I've been doing YouTube, people come at me with two questions. When they hear about crypto and they're really excited about it, they're like, I want to buy crypto. I have two questions though. Is this the right time to buy? And the second question in their mind is, how much do I need to put in? Like to really, like, in a sense, make it in the long term or be able to retire off crypto, how much do I have to put in, right? And I would say that neither of those are things you should be concerned about as an investor. They'll just add stress, and more than anything, they'll block you from getting into crypto until you get the answer to these questions, which may not even be the right answer. And I think the real solution and answer to it is really, as you mentioned, Hope, in this case, dollar cost averaging. And the reason why is because you can work with an amount that's reasonable with your cash flow, from your income, and considering the money you have to set aside for expenses, how much do you have for your investment portfolio or to put away in kind of a savings or investment portfolio? And then outside of that as well, you're not worrying about timing the market. So, you're just averaging in over time, in this case, through good times, bad times, neutral times, and generally riding the upward trend here. And that eliminates both of those barriers. So you can get started today in this case. And again, as we talked about earlier, whether in this case you were to buy the market at the top in this case or dollar cost average, right? Getting started and investing generally at any time is usually a good idea because inflation is almost guaranteed on an annualized basis. And you've got to invest in assets that are going to help you to hedge in this case if you want to protect your purchasing power. That's just statistically true. So anyways, yeah, that's my general thoughts on it.
Yeah. A follow-up question to that might be like, doesn't that require a lot of patience? And like, whenever I meet like first-time investors, and even when I first started looking into it, it's really tempting to watch the ups and downs and try to play the market, and then you get really stressed out because you don't know what you're doing. And dollar cost averaging sometimes can get scary when there's dips, and you just have to kind of trust that it's going to long term just kind of go up like that. Like, yeah. What would you say to like first time investors who are having a little bit of difficulty like being patient and just canceling out the noise when things go to chaos, when there's dips in the market?
Yeah, there's three bits of advice I would share. So like what first off, one is kind of a given with dollar cost averaging, which is it's much less stressful to watch $100 going up. Like, let's start up with $100, right? As your first average, or $200. Yeah. It's easier to start with $100, $200, every 2 weeks versus putting maybe, for example, your life savings like $10,000 or even a substantial chunk of that, like $2,000, $5,000. It's immediately much more chaotic. And that's the thing, is the volatility, in the dollar, the percentage increase and decrease is the same. But, in this case, let's say there's a 10% dip in Bitcoin's price, an initial $100 investment is going to go down $10 versus a $10,000 investment going down $1,000, right? And that's, again, where I say, like, starting off with some big investments really, again, a very chaotic way to get into crypto, just like it would be with stocks or anything else. But the other two things I would say as a tidbit of advice is look at, as we talked about today, a lot of the historical performance in this case. One thing that's just what kind of makes me upset in this case, and I think it's just a narrative that gets shaped, is people say, just invest in the stock market. It's a guaranteed return of X percentage. And in reality, the stock market can go through a 50% correction in less than a year. It's done that 2 times in the last 2 decades. So, the thing about it is that people say, the stock market's good. Well, you could get caught in a bear market, and it's going to take you multiple years to get back to your previous all-time highs. Whereas crypto, yes, although it has more harsh corrections, Bitcoin usually experiences, 80% corrections, roughly speaking, from its all-time highs to its bottom before the next cycle kicks off. The incredible thing is that if you dollar cost average into it, you'll get back, in this case, depending on where you actually start investing, you'll generally get back not only to the previous all-time highs very quickly, but you'll start to make still much higher exponential returns in this case. So I again always look at the data science models. I look at price action long term, and this is going to kind of go in towards the third point. If you're watching the charts on a day-to-day basis, if you even care about what the headlines have to say, you're doing yourself wrong in this case. And what do I mean by that? I mean, I would say if we cared about every celebrity's lifestyle, if we cared about every world catastrophe, we'd be losing our shirt and our minds at the same time, right? So it's not the means of way that you should go about investing. And I really recommend, I know it's difficult too, but you'll learn with dollar cost averaging and focusing on the long term, that all of it's just noise in the grand scheme of things. So that's something that has come true to heart for me over the last couple of years of investing, not just in crypto, but in any market.
Yeah. It's easier said than done.
Exactly. Yeah.
Definitely something you got to have very much long-term vision for. So, Eugene says, why doesn't the Fed include asset prices like stocks and perhaps real estate when measuring inflation?
Yes, that's actually a very interesting question. So the thing that the Fed overall really has one main priority, or at least it states that it has one main priority, and that is to support economic growth. Now, it's not to say that when the stock market's going up, the real economy isn't going up, but they are not directly correlated. So the stock market, to be completely fair, has far outpaced the real world economy and growth. It has had a clear divergence, and it's at the highest, what's known as the PE ratio, the price to earnings ratio. I think we have just recently seen the highest PE ratio in history. This means that people are paying a major premium for stocks. The prices that they're trading at, they're much higher than the actual fundamental growth underlying of these companies and their quarterly reports and annualized reports. So the thing is, the Fed in this case cares much more about the inflation of real goods and services. That's their main focus. But the problem is, in this case, that the Federal Reserve has been printing a lot of money, and a lot of this money isn't going towards facilitating commercial loans for businesses, personal loans through credit cards or home mortgages. A lot of it has been going into the stock market. In this case, it's been going into financial assets. This is a broader issue that, unfortunately, is why we have to be so overexposed to assets. But more towards your point and in this question, Eugene, why do they measure it in this case? Why don't they use it for inflation? Generally speaking, the Federal Reserve has found the measure in this case of measuring the increase in cost of goods and services as a means of inflation. For example, Apple stock going up in this case, albeit it may be, a general determinant that there's a lot of printing, doesn't give me a good gauge in this case of the cost of goods and services increasing in the economy. So that's hopefully that provides. It's a little bit of a hard thing to answer and kind of in a quality way, but I think overall it's just not the Fed's objective in that case. They want to much more rather measure the cost of living or the cost of goods and services.
Okay, cool. Thank you. Carlos asked another question. Says, what stable coins do you recommend? USDC, USDT, or DAI? Yes, USDC is pegged to the dollar, and DAI, I believe, is both half crypto, half dollar, question mark.
Yeah, it's a great question. So overall, this is my opinion. And again, you always have to determine what kind of stablecoin you want to use. There's tons out there. My personal recommendation is USDC. And the reason why I like USDC, albeit it's not as decentralized as DAI in this case, or just for clarity, for those who may not know, DAI or DAI is a decentralized stablecoin backed by Ethereum and other types of crypto assets, maybe even including stablecoins. I really like USDC. And the reason why is because it's founded by two of the largest companies in the crypto space. It's founded by Circle and Coinbase, which are both great companies in this case. I have nothing major negative to say about them. And I would say the only thing that Coinbase lags on is customer support sometimes. But that's a lot of companies in crypto. Outside of that, though, they've done a really great job launching USDC. It's a stable coin that's backed by one-to-one by real dollars in this case, and some kind of bank reserve in this case. Now, not always physical dollars, but real dollars in a bank account, right? So there's no fractional reserves. In regards to DAI, that would be my second best choice. And the reason why I picked that over, say, USDT or Tether is because a USDT Tether in this case lives in a very kind of offshore world. And I think there's very clearly fractional reserves to some degree behind it. Again, I don't want to make any bold claims in this case. There just hasn't been a high degree of transparency, whereas USDC goes through routine audits. DAI in this case is backed by transparent collateral on chain. You can see it. So again, I think that overall DAI is my second best option, but USDC, it's why we love it here at Digifox. It's the native stablecoin for our wallet.
Yeah, and I dropped a link to an article that we wrote about USDC. Yeah, so if you guys want to learn more about it, we have a blog article about it. We also have a video on our YouTube channel too. Eugene asked another question and said, would you rather buy Bitcoin or the Bitcoin futures ETF?
Gene's asking the hard question here. Well, the question where I'm about to go on a major ranting session. Yeah, so I will give the simple answer and then I'll give the long answer. The simple answer is I'd much rather own real Bitcoin. And the reason why is because the recent Bitcoin futures ETF that everyone's buzzing about, which is, look, if you have a brokerage account, you're familiar with that, and you're looking to trade and maybe you hold something for you. Nothing too terrible with holding BITO, which is this new product that's launched, this new Bitcoin ETF. But the problem that comes with it is that There's a lot of different types of ETFs. If the ETF in this case was what's known as a spot ETF, where you backed it with real Bitcoin per share issued, then that would actually be great in this case, so long as you're fine with someone else holding your Bitcoin. Right? We're fine with the idea of custodial services, right? But the problem is that these ETFs are backed by Bitcoin futures contracts. These are paper contracts that are basically helping to protect investors who want to mitigate or hedge their risk on the price changes of Bitcoin. And some people use them in this case as a means to trade the underlying asset and the price differences of it. So you're basically buying a financial product that has no real Bitcoin backing it. And to make things worse, to make matters worse, the problem is that these futures contracts expire. So they have to roll over into newer futures contracts. To put it in really simple terms, that means more added cost for you. So you don't own the real asset. It's being managed by someone else. And the worst part is there's no real Bitcoin backing it. Whereas in this case with Bitcoin, you can not only have real Bitcoin in this case, you have full autonomy. You can also deposit in a protocol like Celsius earning interest, and it costs you nothing to either have it deposited on Celsius or within your own seed phrase wallet, as we'll have launching with Get Paid in Crypto. And the same goes for Ethereum and Litecoin. Why wait for financial products when you can just go buy the real stuff? So I think this is, again, something for if you're here right now, you may be someone who's still looking to be passive about crypto, but you're a little more in the know in this case. You're more eager to get into it. And I think that that's something to be proud of. You're catching the wave earlier than the broader crowd. But I think BitTo, in this case, the Bitcoin futures ETF, is for more of a general audience looking to put it in their pension funds or 401k, things of that sort. So
awesome. Cool. Anonymous attendee asks a question that probably crosses into financial advice. So we can't give financial advice. The following is just Nick's opinion. But he says, would you recommend holding off on profit taking until the next halving cycle where prices have the potential to be higher?
That's a great question. Again, thank you, Hope, for the predetermined statement as well that it's not financial advice. I mean, look, I would say, guys, that to be completely fair, it really depends on how you want to approach markets. So we've been talking a lot today about dollar cost averaging, and dollar cost averaging is great because it completely, if your time preference is 5 years, I mean, man, dollar cost averaging is a hard to beat strategy. It's something so, simple, low stress. In this case, you don't have to do anything. It's just every week you're averaging in. And outside of that as well, as your time preference, as we showcased earlier, the longer your time preference is, the higher you have in this case to outpace your initial investment and any other type of asset class, right? Generally speaking. In regards to considering the halving event, it would really depend in this case when the halving event happens. Usually the halving event happens towards the kind of like the bottom, kind of the slow exit of the bear market. I really don't think if there's a chance that we go through what's known as expanding cycles. And we talked about that in a previous webinar where from bottom to top in the cycle, in this case, from lowest price point to the highest, that the time frame is expanding, generally speaking, that we might have a weird overlap where the halving event is in the middle of a bear market. And it may not be as effective, especially now that the halving events are reducing supply. Even though it's still half of the new supply introduction, it's much less in this case than the reductions of the past. So I think that the halving events are going to become a little less, they're going to become a little more redundant. They're not going to matter as much. So that's my general thesis. I would say not to worry too much about the halving when taking profit. It's more about when price action is euphoric, your grandma's talking about crypto and showing you her crypto portfolio, things of that sort, where there's a lot of buzz, right? That's the thing I would look out for and be a little bit concerned about.
Cool. Thank you. Mark asked a question. If you guys haven't had a chance to talk to Mark in our in-app chat system, Mark is one of our client success champions. And he says, for those, and I'm going to change this into kind of a 3-part question potentially. Mark says, for those who don't know, and we might end on this one because we're a little over time. For those who don't know, what cryptocurrencies will be available with Get Paid in Crypto? I personally know Litecoin is one of those, and it's not talked about as much in terms of so we're having Bitcoin, we're having Ethereum, we're having Litecoin. hopefully more in the future. And there's a lot of talk about Bitcoin. There's a lot of talk about Ethereum. I don't hear a ton about Litecoin, or what makes it special. So if you want to touch on that, that would be great. And also potentially the difference, if any, from dollar cost averaging and get paid in crypto, or are they the same thing?
It's a great set of questions. Yeah. So, in regards to the differences between dollar cost averaging, I'll dive into that one. Dollar cost averaging and getting paid in crypto. They are generally the same feature, but there are a couple added benefits as to how it operates. So, for example, there's some apps out there you can dollar cost average in today. You can go utilize, and look, they're great services for the most part. But the problems that you're going to hit are a couple things. First off, most of them don't offer interest earning capacity or capabilities. We offer that through our integration with our partner Celsius, where you can earn up to 5% on your digital assets like Bitcoin, Ethereum, and Litecoin. Outside of that as well, you run into some friction points. With dollar cost averaging, a lot of platforms, they sometimes encourage you to do an average every single day or once a week in this case, right? The problem with that is if you're doing smaller amounts in this case, you're doing like 10, 20, 30 bucks on a daily basis, the cost between fees and the spread and just the general underlying costs that are going to be baked into those transactions are going to be much, much more, generally speaking, than you would doing a biweekly, in this case, a biweekly average through your payroll, right? Your salary, and much larger quantities, like $100, $200, $300, possibly even more. That's what's going to help you in that case to actually benefit more in the long run, not having to be bogged down by fees and costs. And what's great about that is you're really not going to see a difference in performance. Statistically speaking, historically speaking, you don't see much difference if you're to just average it every single day or every 2 weeks, right? You're generally getting in at different phases of the market, just like you would dollar cost averaging on a daily basis. The other third point I want to make, this is the biggest friction point. It's one that I'm a bit not per se emotional about, but I think it speaks to the philosophy we all resonate with when it comes to crypto. I can't tell you all how many times I've either had issues or I've heard people in the community having issues when they're trying to use their debit card or they're trying to connect their bank account to buy crypto or dollar cost average, and their bank freezes their transaction. And look, I mean, it wouldn't be bad enough in this case if banks were walking away with 15, 20, 25% profit margins when they pay us nothing, the depositors of these banks, our money in this case, right? They treat it as if it's not ours, right? That would be bad enough, right? And then they turn around and charge us credit cards that can be as high as 25%, right? No, that wasn't bad enough. They freeze transactions because they don't want to touch crypto. They think, crypto is this kind of far out thing, and maybe it's a challenge to the banking system. Well, what's really cool with the way the get paid in crypto works is that we have a partner in this case we work with called Hedge that helps to facilitate this underlying service within the app. We're the first wallet exchange they're integrating with. And the really interesting thing about it is that when you get your paycheck, the portion that you've allocated for crypto, it goes into a bank account that's generated through the entire onboarding process within Digifox and get paid in crypto. And money goes in this case, into a bank account under a banking partner through Hedge that is pro crypto. They're totally cool with crypto. They're not going to freeze any transactions. Money in, convert into crypto into your wallet. Simple formula. No questions asked, right? Because it's coming from your payroll in this case, coming from your job. And you've been KYC'd in this case. You've gone through all the rigoram of going through and interacting in the banking system. So they're totally pro crypto. Money in, crypto out. And it removes this barrier of friction in this case. And I think of it in a sense, if you want to view it in a macro sense, it's the ultimate on-ramp for crypto, in my opinion, the frictionless on-ramp to get sizable amount of capital into the crypto market. So that's something that's been debated and talked about for years of how to really get sizable amounts of money and prevent the banks from freezing it. You're always going to have to go through a bank, but it might be as well banks that are pro crypto. And not having to change your actual commercial bank. That's a really cool thing about it. Now, to step out towards the first question, which is about Litecoin, Mark asked a really interesting question. Why is Litecoin not talked about as much as Bitcoin and Ethereum? And to be completely honest, and I'll share my candid opinion, I don't find it to be as exciting as an asset against Bitcoin and Ethereum, but it is one of the large cap cryptocurrency plays. And an important thing to note is that whereas many people see gold as a kind of larger asset to silver, and silver is kind of a complement to gold, the same goes for Litecoin to Bitcoin. Bitcoin very similar to gold. Bitcoin being very similar to gold, and Litecoin being very similar to silver as kind of like a secondary digital commodity, right? And the thing is that Litecoin really, at the end of the day, it's like Bitcoin. It's a semi store of value, and it can be used for payments. I can send Hope some Litecoin right now to her address. What's really nice compared to Bitcoin is that it's generally going to come with lower fees because you have a block time that's a quarter of Bitcoin. So your transaction versus being confirmed at about 10 minutes can be confirmed at about 2.5 minutes. And outside of that as well, Litecoin runs with a different hashing algorithm, and it has the same block size. But those are the general main changes with Litecoin. The supply is a little bit different, it's a little bit larger. So again, like silver, a little bit more abundant supply, but not too big in this case of an increase against Bitcoin. So that's the general three differences there for Litecoin. In the sense of news and developments, Litecoin has started to come up in the spotlight once more. So there might be some potential growth potential against Bitcoin and Ethereum. But generally, historically speaking, Bitcoin and Ethereum both outpace Litecoin. So those are two of the best performing assets out of the three.
Okay, cool. That's good to know. Thank you.
For sure.
Ryan asked a question, and this is going to be, really sorry guys, but probably the last question because we're already about 15 minutes over time and it's like midnight where Nick is. And if you guys have more questions, feel free to drop them in the chat in our in-app chat support or on our website at digifox.finance, but we'll ask Ryan's question really fast and then we'll be done. It says, hi Nick, big fan. Thanks for your time and expertise. Is it worth halting or deferring purchases in dollar cost averaging around cycle top periods, or would you continue to do so whilst taking profits? He says, I'm still a crypto noob in the spot market, but I'm looking to make the change to the next cycle when I'm more prepared, hence attending your seminar now as an educational piece. And he wants to know if you have any recommended reading, and that would probably kind of go into like if someone's new to the market, they want to do education, they want to like do research, like what are the best educational resources out there for them?
For sure. Ryan asked a phenomenal question. Now, there is some things I can't talk about that I would love to share, but I can't because we like to keep things behind the scenes while we're working on it. And we like to talk about something when we've done it, in this case, when it's delivered. But long story short, to your question, Ryan, in this case, you're definitely right. If you were to know how to generally not time the exact top, right? You don't need to do that, but generally know when you're like a couple days, couple weeks, and maybe even a month away from setting the cycle top, 2 months away, even with that wide time frame, you would benefit greatly in this case, dollar cost averaging, and then not averaging it, in this case, the top, waiting for a discounted range. So we're exploring some ways to actually improve upon DCA, dollar cost averaging, that again, I can't talk about, but some ways where hopefully you won't have to time the top in this case. That's something we're looking forward to. But yeah, I mean, look, it's up to each their own in this case. With Get Paid in Crypto, you can terminate Get Paid in Crypto anytime you want. You have to contact your employer. It's not something we can do because it's the payroll flow from your job. So we help generate an email template to cancel it. In this case, it's dependent on your employer, effectively changing that in their payroll or your HR department at your company, whoever you communicate with, or maybe you implement it in your self-serve solution if you have automated payroll. But yeah, I mean, that's basically something that you can consider. And then you would wait for prices to go down, towards the bear market. And in that meantime, you could save up cash, in this case, buying on discount, right? That's something you can do. The one thing I'll say, though, is that it's not always easy to know when that top is or when that bottom is going to be, unless you really get into the data science. I would say one resource, I know I'm a bit biased, I'm not trying to shamelessly promote myself, but we talk a lot about the cycle analysis on Data Dash. So there's a lot of great free content there. But I would look into the basket of tools that we utilize. Look into bitcoin.com. It's a great data science metric platform where you can see a lot of different data science models and find out if we're overextending the cycle or at a discount. And then what I would say as well, finding bottoms in crypto markets are pretty simple. If they're down about 70%, that's the period of time where I'd start averaging in, because you're getting close to that 80% figure. So those are just some quick tidbits or thoughts that I could share. But again, I don't feel the need to overtrade, but if you do the due diligence, you can definitely do it. I wouldn't discourage people from it. So.
Well, thank you so much, Nick, for jumping in and staying over time, answering questions, and going through all the dollar cost averaging information. It's very informative and educational for me, and I'm sure for everyone else on the call. We're going to post this on YouTube later for you guys. I'm sure Eugene will take some mini snips and clips of this webinar too, and just kind of post shorter videos if anybody, if you guys want to go back and rewatch parts, or there's people that missed it that want to go back and watch it, or if there's just time zone differences that make it difficult for people to join. But thank you so much again for joining, Nick. We'll do another webinar. We'll try to do webinar once a month. So probably at the endish of November, we'll do another webinar. If you guys have topics that you are interested in, message us in Intercom, which is our in-app support chat, or if you have any extra questions that didn't make it into this Q&A, definitely feel free to reach out on our Intercom system, or on our website at digifox.finance. There's a chat bubble at the bottom there too, which goes to our team. So thank you guys all for being here. Thank you so much, Nick, for being here as well. And we will see you guys all in the next webinar.
Cheers, everyone. Cheers up. Thanks so much.